Hey, good afternoon, everybody. It's Arthur Laffer, my partner Nancy Tengler, and we are here with our macro micro moment. And we're back because last week you were missing me, right?
You were missing. I was there.
Oh, that's right. What? No? Huh? Ooh, where? You're very orange today.
Yeah, look.
You getting in the Halloween spirit?
No, I was pink and orange, and then it got really hot here. It's 85 degrees in Tahoe. That's hot.
Wow.
Yeah.
It's hot.
All right. So
Busy
what do you
week
want to
this
talk
week.
about?
Busy
What's
week
that?
this week, I think. We've had you've got earnings wrapping up, which I think we're going to talk about in a little bit. You want to talk about some earnings and what's been happening there? Any surprises? And on the macro front, we had a pretty big release calendar this week. Last week was kind of dead, but this week was actually pretty busy with the inflation numbers primarily coming out. And then next week, we've got some follow-up to those numbers as well. And should we tell them what our bet is?
Yeah.
Okay,
you
so we have a bet. I bet our bet is the next FOMC meeting, which is towards the end of September. I think it's like the third week. Nancy's betting that they're going to cut the Fed funds rate by 25 basis points. Actually, it doesn't matter. They're going to cut it. And I think the FOMC is not going to cut it for lots of reasons. But either way, what I think is going to be interesting, Nancy, is whether the yield curve continues to steepen. The interesting thing is that, I'm already reading about the Fed put again, which is, the Fed's going to have to, cut rates drastically. You've got Scott Bessent out there saying, he wants 150 basis point in cuts. The president wants 300, 350, cut it to zero,
minus 100.
Yeah. But the joke always, at least in my family business early on was, does the tail wag the dog or does the dog wag the tail? And I think we're getting into an environment, my opinion, is that the people think that the Fed really sets rates and it doesn't. And even if the Fed cuts, guess what? Mortgages aren't set off Fed funds. They're set off the 10-year.
But this is why I'm going to win.
Yeah.
I've already spent the money, by the way. Supremely confident. The mortgage rate's coming down.
Yeah, well, it's come down 10 basis points or so. But yeah, I mean, I think the 10-year bonds right now waiting to see kind of what's going on. Bostic, by the way, just had a speech. You got a lot of people doing speeches today, so we're going to hear comments on that. But Bostic came out and says he still sees one cut. I think what's also my favor is if I'm right about the tariffs still showing up in the numbers, and I think some of the numbers are actually leaning towards higher inflation. It dipped down quite nicely until the last couple of months where it's been popping back up. You got core CPI back up. You've got core PCE back up, moving back up, as well as, people worry about weaker labor market. I mean, it's only 4.2. It's been at 4.1, 4.2 almost every month for the past 12 months. So it's interesting to see, and the deficit's still increasing. We hit 37 trillion on the national debt. So,
and we've hit all-time highs in the stock market every day.
I know.
And
the money's got to go somewhere.
Well, that's a good one. Can we go to what nobody's talking about and why I think stocks will continue to go up? And it dovetails with what you're talking about. So, I didn't originate this research. It was done by a firm called Zion Research, and they went and looked at the implications for the One Big Beautiful Act.
Bill. One Big Beautiful Bill Act. OBBA.
Bill Act. Oh, yeah. Whatever it's called. And they said, okay, what happens? What are the cash implications for U.S. corporations on the 100% bonus depreciation? So remember, businesses can fully and immediately expense most depreciable assets. So that's that. Then you've got the upfront expensing for R&D, which is a one-time benefit. Mm-hmm. And then deductibility of interest expense, which, by the way, I would like that since I can't seem to get my American Express card back down to zero. But anyway, they determined that it would save, and they were only able to calculate it on the top 400 S&P 500 companies, $148 billion in this fiscal year alone.
Yeah.
148 billion. 38% of that is Microsoft, Google, Amazon, and Meta. So these are the companies that are the hyperscalers that are spending on data centers and generative AI. And there it is. So what are they going to do with the cash? Well, some of the companies and most likely Meta for sure will reinvest in additional CapEx, but some of the money will be used to do share buybacks, which put a floor under the price of the stock. Maybe increase dividend, maybe add a dividend. So I think it's super interesting, and nobody's talking about it, nor are they talking about the benefits to the consumer, and particularly the low end consumer, because there are some tax credits in there that you and I have talked about in the past. But what do you think? I think that's going to continue to drive margins and earnings as we move forward.
I think there's so much money flowing. I mean, honestly, Nancy, this, what you just pointed out, is just another huge flow coming into companies. I mean, you look at the tariffs, but you look at the investment deals. I mean, he goes in and the president goes in and talks to Tim Cook. And the next thing you know, there's 550 billion, $650 billion he's going to invest in the U.S.
Correction. That's what the president said.
Yeah.
The company had already announced, this company had already announced 500 billion, like in previous years, to be done over the next 4 years. Okay. That was before he got elected. Yeah. And of that, incremental to that 500 billion is like 28 billion that's incremental, and 1,000 jobs. I can't remember what the original job promise growth, I think it was 2,000 jobs or 22. I don't know. It was a lot. Then now they've added another billion to be invested over 4 years. So sorry, I just want to, I mean, I know what the headline says, but.
No, but I guess my point really was, there's so many of these large numbers where you've got material investment projects going on. The president has been very effective at cutting deals. The details, the devil's in the details always, I think, with any politician, let alone this one. But, you know, you've got Japan has agreed to basically set up an investment fund, a direct investment fund. Now it's a fund. It's not like they're just
Saudis
to the U.S. The Saudis, you've got Taiwan doing the same thing. I mean, you've got that TSMC facility in outside of Phoenix, right?
Yeah, true.
So, I mean, I think U.S. manufacturing. This is a lot of money. It's not the shovel-ready garbage we got from government spending, which never works well. That's why there's really cool roads near my farm up in Kentucky that no one uses because they're shovel-ready. That doesn't really help in the long run. It's like a quick sugar rush. These types of investments from smart people that are making like business decisions with their own money usually tend to be much better planned out. And to your point, it's like the flows from the OBBA bill and all of this investment, this is going to show up for a long time.
It is. It's a tailwind, I think. Yeah. And that's, you know, what you're hearing is all the negatives around tariffs, right? And how it's going to show up in inflation. And you're one of those, right, that thinks it is going to come through. But what I guess I'm saying is there's an offset to that is probably far greater. I mean, in the last quarter, Apple, for example, had $800 billion in tariff expense. And they estimate next quarter it's going to be, I'm sorry, what did I say? 800 billion. And next quarter it's going to be, sometimes I get the billions and the millions. It was 800 million. And next quarter it's going to be $1 billion in tariff offsets. But if they're going to benefit, and this research that was done, well, they don't include Alphabet, but they're going to benefit also, and from 100% expensing interest deduction. So I think there's going to be a far greater offset through the parts of the bill, and then that's not even counting deregulation and the powerful impact of continued deregulation on, you know, energy, materials, and to some extent technology. And then add in the fact that the president wants to keep the dollar low. I mean, he wants the dollar to be weak. That benefits the multinationals, and in particular the tech companies. So there's a lot of tailwinds that nobody's talking about, and that's why I think the bears are wrong, and they're going to continue to be wrong.
You know, what's interesting is that, you know, if you believe the dollar is going to continue to weaken, right? That's definitely going to give a bias towards exporters. But if we don't have enough export capabilities in the U.S., we're going to have to develop it to take advantage of that more often than not. Weak dollar tends to give an inflationary bias to the system as well.
Right.
It hurts domestic savers much more than it does foreign investors. So foreigners can buy, obviously, our goods at a cheaper relative price if our currency is depreciating against theirs. But it also means that U.S. consumers have a much harder time buying foreign imports.
Yeah, well, and it's funny, Arthur, you reminded me, I'm sorry, were you done? Oh, I don't really care. I wrote a piece on is American exceptionalism dead? Because what we're also seeing is that, remember, we've been hearing that nobody wants to invest here anymore, and it's because of the tariffs, and nobody wants to come here anymore because of the president's policies. But in fact, we're seeing a resurgent and all-time highs in flows into the U.S. from foreign investors. And I think that's one of the reasons that the 10-year's just been staying range bound. Yeah. Because they're buying our debt and they're buying our stocks and they're investing in the country.
Yeah, it's interesting though that if the curve continues to normalize, you could have you and I have spoken about this. I think we spoke about it in a previous show. If the term premium over inflation is, say, for the 10 years, 100 to 150 basis points historically, you can get the Fed cutting the Fed funds rate from 4.25, 4.5 right now all the way down to 3%, and the 10 years should still be roughly right where it's trading. So this is where it's interesting, Lance. You may win the bet, but the question is the president going to get what he wants? And I don't think he's going to get it. I think what's going to happen is the yield curve is going to continue. I think it's just going to get steeper. You're going to see the short end and the long end get farther and farther apart. The curve is going to normalize much more, which is, by the way, a very difficult fixed income market to play.
Well, right. But then also remember, it was just last fall that the 10-year was at 3.6%.
Yeah. And then it got up to almost, it almost got to like what, 4.6, 4.7, 4.6.
Right. After the Fed cut 100 basis points. So I don't know. I mean, you're being logical and basing your assessment on fundamentals. I'm not. I'm just saying, I think the trend and the pressure is down.
Yeah.
And there's a lot of job owning going on. And I know you'll say, well, that's not how the bond market works, but we'll see. I mean, I don't know where I'm going to spend that $100.
I think the bond market.
Yes, maybe.
Probably on like cheap Starbucks because of inflation. It's going to make it $50 a cup. What's interesting about the bond market, it's really funny, at least I've noticed the last several years, this thing has become, at least my view, has become more prevalent, that it's the day-to-day is this headline risk that we keep talking about, where Bessent comes out and all of a sudden says he wants the Fed to cut 150 basis points, which I'm telling you right now, there's no justification right now for a 150 basis point cut this year. That's not saying they couldn't do it, but there's no justification for it. Credit spreads are still incredibly tight, which means credit's very available. So it's not like, and that would typically cause rates to behave differently. What I'm concerned about is this headline risk of whipping around. Now the odds of a 50 basis point cut in September, like, it just jumped up to the roof, whereas they were like 10% yesterday, and now it's an 80% odds of September cut. But I think the Fed meeting is on the 16th, 17th, or 18th of September. The next CPI print comes out on the 10th, 11th. So it's early in the month. So we'll see it, because if these inflation numbers keep staying up around the 3+% range, which is where they are, and employment continues to hang around this 4.2 range, 4.3 even, I mean, no big deal. Those are great numbers. And I mean, Powell, as much as we don't care for him and don't think he's done a very good job, he may stick to his guns. I think he will.
Oh, I mean, I think what he's proven is that he can be stubborn in the face of the facts and not humble. I mean, I started writing, as you know, negative pieces on his tenure in the summer of 2021. And
three big market corrections.
Yeah. And he caused the first one and the third one. He didn't cause the COVID one, but remember, he raised rates in 2018 because he was worried about Trump's tariffs and Trump 1.0. And so then we got the bear market of 2018 that ended on Christmas Eve. then we had COVID, and then we had the 2022 bear market, and that was all on him. And I think, my favorite that I wrote was, time to replace the Fed with Chat GPT, because at least Chat GPT learns from its mistakes. He doesn't, and he's unapologetic.
Yeah.
So they meet on the 17th.
Yeah, and I think CPI comes out the 10th and 11th. I think the inflation numbers do. The unemployment and inflation was right that second week of September. So they'll have that reading to go into the September meeting with.
So here's one more little known thing I want to talk about, and then she's all yours. Well, maybe, but remember too that this, the analogy we've drawn to the 90s, inflation was at 3%, and the 10-year was between the Fed funds rate was at 5%, and the 10-year was between 7 and 8. Yeah. So it's not disastrous. I think what we need to see is housing kind of unlog jam, but other than that, I don't think policy is going to cause a recession. But if you look at the GDP numbers, and I know you know this, but I just want to remind everyone, and we have a chart on this, but if you look at the first quarter GDP, and it was negative, I believe, right? Slightly negative. What you can see in the top part of that chart shows it. So Q1 exports, and that's all the way over to the right, net exports, which is exports minus imports, and imports were up dramatically because people were trying to front run the tariffs. Imports are deducted from GDP, so they had a negative effect on GDP of over 4 percentage points. That reversed last quarter. And so what you're hearing for the second quarter, so what you're hearing all these people say is, oh, look, GDP growth is at 3%. And it's mostly people from the administration, people like Kevin Hassett, and I think he knows better, but he has to say it. Look at us, we're growing quickly. But, the fact is that it's all distorted by the activity that took place. So we are decelerating from last year, where I think we were up 2.8% in the second half of the year. So that, again, that actually augurs well for equities, risk assets, and also in particular, the reliable growers like the technology names that we've been in, stayed in, doubled down on during the bear market, and then have added to during the tariff tantrums of April. And now we're once again sort of trimming back on them because they've appreciated so much. So I think it'd be wise to also pay attention to GDP. That's all I'm saying. What really went on.
And one of the things you've spoken about quite a bit is this whole kind of AI trend, how that's really acting as what I would say is a force multiplier for labor, and how hard it is to really track that and actually show its real impact on productivity and GDP. Right. We've had all this kerfluffle lately about, replacing the head of the BLS because the whole issue with, the restatement of the non-farm payroll numbers during Biden, but even actually going back multiple years. I think going back to 2009, I saw a report recently that showed hey, this isn't new. These restatements sometimes are really big, and it really begs to ask questions about how BLS, BEA, and all these guys do these physical surveys still. And
right.
We filled them out. I mean, a lot of corporations, small business, big ones too, have to fill out these surveys. And everybody has their own little survey, and they may be asking similar questions, but for different reasons. And then you get into the whole seasonal adjustment issue. And is it capturing the ICE issues with labor, with the lower end labor force, like leaving? I think there's been an estimate 2.8 million people that have already left the country because of the crackdown on illegal employment, as well as the whole impact on AI. And I think you talked about when you first got a computer, I forget what firm you were, was it UBS?
No, I was at Bank of California, and I was the only one that had one, and I spent half the day trying to, what should I do with it? I could type myself a note. I mean, there was no network, so there was no value. Stories
when we were when Laffer Associates and Europeans, you didn't mail to Europe because it was too expensive. So what you do is you'd fax the paper.
Right.
But these groups, just like yours, you'd have one teller rate. They had one fax machine, and the funniest thing is that the Germans would turn theirs off at night and on weekends. So the one time you want to send a fax because no one's using it, and they turn the damn thing off. But hey, but yeah, you look at the productivity gains when you actually had software networks, you could actually be productive. How much more work you got done?
Yeah. Well, and it's not, I think what you're saying too is, and we've talked about this, it's not being measured correctly.
Yeah.
So if you've got the BEA calculating output, because they calculate GDP, and then you got the BLS calculating the number of jobs. So that's what productivity is, output per employee. It's grossly understated. And the numbers moving up, I think the numbers probably at least double what we're seeing. And we just see it in our own business, certainly. And in our relationship, we spend the whole time when we're talking to each other grokking stuff.
Yeah.
So yeah. So anyway, that was all I wanted to say about that. I did look up the constitutionality of the export taxes. Not constitutional.
I didn't think so. I think Congress has to do that. I don't think the president can unilaterally put a tax on like that.
No, he can't. It's Article 1, Section 9, Clause 5, and it's called the Export Clause. And it says, no tax or duty shall be laid on articles exported from any state. Very bad.
You missed your calling. You should be arguing in front of the Supreme Court.
It's grok. Yeah. Anyway, and there's case law that supports no export taxes. So,
well, honestly, it's just bad policy.
It is, yeah.
Yeah, it's bad. It's a bad precedent and bad policy.
Yeah, I agree. So anyway, I'm done yapping. What have you got?
The only thing I wanted to add before we talk about, before we go on, I think we'll take a break and then do talk about earnings and stocks to watch is, I thought we were getting to the end of this whole tariff negotiation point. We'd wrapped up a couple of big ones like Europe, China. For the most part, I think that we've got the framework for it, although it's still not finalized. But a lot of the other ones are done, like Taiwan, Vietnam. And I thought India was done, but it's not. And it's this thing we don't talk about very often, but it's Russia. It's like Russia. You know, they're this thorn in the side. They keep the pressure on all of Europe, trying to figure out what they're going to do. There's this kind of static war scenario in Ukraine. Their economy is not performing well, although I don't even know how reliable those numbers are, by the way. You want to talk about bad numbers on their economy. I don't know how people are figuring that out here, and I wouldn't trust the numbers anyway. But they're continuing to cause problems like with India trade deal, because India's been basically buying black market, what they call black market, sanctioned oil at a really low price. Why? Because it's in their best interest to do it. It actually saves them a ton of money. So I know why they're doing it, but it just caused the breakdown of the tariff agreement between the U.S. and India, which is really important. It's not a big dollar amount yet, but it's, they're the replacement for China as I see it. And they're much more aligned philosophically with the U.S., unlike China, which is not.
And by the way, that's how Tim Cook saw it at Apple. So he, obediently moved stuff out of China after Trump 1.0 and moved it to India. So It's going to be. I was laying in bed this morning and watching Bloomberg on my phone. How sad is that? I mean, that is a low point.
That's pretty
and
good.
They had this grocer, and he's holding up a bag of shrimp, and he goes, "This is a problem for us because India produces," or he said grows, the most shrimp in the world. Did you know that? I did.
No, I didn't.
Yeah. So there's stuff you don't think about, of course, but yeah, you're right. It's going to be interesting.
Pharma, like the cheaper pharma stuff. I mean, remember during COVID, and they were like, well, we think we're not going to export it out because we want to make sure we have enough stuff for our own citizens. And everybody went crazy because they had outsourced all the pharma to places like India. And, that's why we're trying to bring these things and insource them back into the U.S. So we have these critical supply lines that aren't like all of a sudden the country goes, hey, we're not going to give it to you. I don't care if your company owns it or not.
Plus it's quality control for sure. Right. Yeah. So, well, good. It's good to have you back. How was your vacation?
It was great. Got all the kids together, which is always nice because, they're spread apart and they've got their own lives. And so it's always nice to see how well they're doing.
It is great. They still come. And I noticed that you got super tan.
Yeah. Me, the tan man.
The joke is outside. He doesn't go outside.
I
Okay,
always
Greg.
told the story when I moved from Chicago to California, and everyone in California was tan, and I walk in and I'm this pasty white, which I'm naturally, but I was even worse than normal. And I could go to the nurse's office, and they're like, "Oh, you look horrible," and send me home. I could get out of school whenever I wanted because I was so pale. Yeah, good times.
Yeah, well, you got to be good at something.
I know. Keep the bar high.
All right. Break time, and then we'll be right back.
Yeah, we'll take a break. Thank you, everybody.
Yeah, and questions, people. Send us questions.
Sounds like a Toad the Wet Sprocket riff. So Nancy, earnings season's wrapping up, and you want to talk stocks. So let's get into it. What's going on?
All right. Can I tell a bear story first?
Of course, you can tell a bear story.
Yeah. So the other day I looked out my window and all the neighbors were animated. I thought there was a fight. And I told Arthur this. I went out and finally, and a bear had gone into my neighbor's garage. And we call him Mr. Tahoe because he's always telling me, be careful, shut your garage door. Don't forget, it's garbage night. They all think I'm, need a lot of help. So he left his garage door open. The bear went in, opened the freezer, and took out a tri-tip and then ate it on the driveway. So now fast forward, yesterday I was looking out my window again and I see this, and I'm talking to you on the phone, and I see this giant bear walking down the street. And I mean, they don't move very quickly. They don't walk fast, but they move a long way. And so you were like, oh, we'll just put it on video. I couldn't get it to work. So I did finally take a video after I hung up with you, but he was one big dude. He walked across the street to my other neighbor's house, picked up his garbage can and threw it against the house because it was empty. It's just,
where's my food, man?
And we have bear boxes, and one of them, not in my neighborhood, but a little ways away, the bear pulled it off its foundation. They're cemented, and then they have like metal poles, and then this metal box. So they're getting hungry. This happens always starts in like mid-August, and then September they're turning over garbage cans on garbage day, and it's.
I guess if you really wanted to like ruin someone's day, you just throw a couple stakes up on the porch and stuff. Just let the bear go to town, tearing up and pooping everywhere.
All right, sorry. Stocks to watch. So earnings season was kind of spectacular. 83% of companies beat. Now that was before today when Cisco sort of beat, but Yeah, 83% beat on earnings. This is the important number, I think. 80% beat on the top line. So that means, they weren't like managing earnings because of the tariffs. They're just not having a material impact on corporate America in toto. I mean, certainly the retailers are suffering. A lot of the consumer staples names are suffering because they're getting directly impacted. But we're a service economy, so a lot of the tariff impact has not been big. And the 80% number on the top line, I don't think I've ever seen that before. It's usually about 60 to 62%. Now, that did not necessarily translate to every stock doing well after earnings. But there were a couple that I think I just wanted to talk about. And I didn't tell our trustee and valued producer all the names I want to talk about, but quickly, Apple's a name that has underperformed for over a year. As you know, Arthur, we got into the stock in 2012. It's up, and that was right after Tim Cook became CEO. It's up 32% a year annualized over that period of time. But we were, trimming, and then we were actually selling, and so it was a minimum position in our portfolio. And on Tuesday last, right before they announced their big investment, we actually added pretty significantly to our holdings at $200 a share, $202 a share. And you can see that in a week, the thing is up, 30 bucks. So they had great earnings. They delivered 10% earnings growth. They had growth and double-digit growth in iPhones, Macs, all of their businesses. Now, there's some question about whether this was an anomaly quarter, but I think it's important to note that great companies will figure it out. Now, Dan Ives, our friend, has come out with a report that said this is Apple's BlackBerry moment. If he knows that, I think they know that, and they're struggling with AI because they're trying to maintain their privacy commitment to their users. But I still think it's a name you want to own for the foreseeable future. And so we may add further. We may add it to our 12 best ideas, but I want to see how this antitrust situation works out with Google, because if they're prohibited from previewing or preferring Google Maps, that's $20 billion a year in revenues. That's a lot of dough, even for that company.
Let me ask you a question in that regard. So you got some of these tech companies like Apple's obviously huge. I don't even know how much cash they still have on hand. What is it, like $10 trillion? Like it's the size of.
Well, they spend it down. So, but the revenues are over 400 billion a year. So.
What do you think the odds of these companies being basically forced to spin off some of their new lines of business, whether it's AI or robotics, and keep the legacy, maybe the hardware side, or maybe the Mac OS like that? Because you're seeing a divergence, at least in my mind, you're seeing kind of a divergence in the core business structure as they try to reach out into these areas that are not maybe core. Do you see maybe Apple having to spin off some of its business, like, or even Google or any of these guys?
So yeah, I do. I mean, I think it would be awesome, by the way. It would unleash value. Now, less so for Apple, but Google is up 7% for the year, 6.7%. But they had an unbelievable quarter. And I just want to read you some of the highlights. They had 14% revenue growth. YouTube Shorts hit 200 billion daily, which far surpasses Netflix. They had cloud growth of 32%. They've got $106 billion in backlog. Wow. Gemini, which is their AI offering, usage went up 35 times year over year. They raised CapEx to 85 billion for the year, but they had 450 million monthly average users and daily requests growing over 50%. For Gemini, which is their Grok, in the quarter, and yet the stock trades at 20 times next year's earnings. So they're not getting the value for Waymo. YouTube, they just started breaking out YouTube and numbers so you can measure. So yeah, I think if that company was forced to split up, it would actually benefit shareholders. Apple, little different, more vertically integrated. It's a hardware company, even though there is obviously a software component. But I think it's going to be interesting in the coming years because Nvidia, which is one of the stocks we were going to talk about, is a $4.4 trillion market cap. That's nuts.
Crazy.
And so at some point now they will continue to grow. We're going to be trimming some of it because it's just gotten to an outsized position. But we were late to that name, and I think our average cost in the shares is between $80 and $90 a share, and the thing is trading at 180 or 170.
What about that unsolicited offer for Chrome?
For Google?
Yeah.
No, thank you. I was going to mention that. So Perplexity is the AI company that everybody wants Apple to buy. And yeah, they made an unsolicited bid for Chrome. And I think it's hilarious because the ruling hasn't come down yet. But yeah, I think there's going to be a lot more M&A activity. We've already seen it. Goldman Sachs just hit an all-time high, which is in our 12th best. But yeah, Nvidia's at $181 a share. So, and it was already up a gazillion % when we bought it. So I think, on some of this stuff, we're going to be late, a little bit late, but not too late. So, because we need earnings, we need valuation, we need some things that some managers who are just momentum managers don't need. But that's okay, because as you know, TGLR had its second birthday, top percentile, trailing 1 year, year to date, 3 months. And then over the 10-year, we know that the track record for the same strategy is in the top percentile. So we get there. And we get there, I think, with smoother returns and lower turnover. But we made it. Last thing I'll say is we made a big shift to housing. And that's because I'm going to win the bet and interest rates are going to come down. And so we did buy a home builder. We bought D.R. Horton. Southwest coverage, low-end consumer, 68% are first-time buyers. Average sales price for their homes is $365,000. They had terrible earnings. I mean, sales were flat, cancellations were up. I think, average sales price was actually down 4% year over year. But the stock's up 18% since they reported earnings. Why? Because they increased their share buybacks. And that, again, puts a floor under stocks, and investors care about that. We added Sherwin-Williams, paint, which will also, it will grow twice as fast as the market once housing takes off. They've put a number of their competitors out of business, and they're locally sourced. So they don't have any, tariff situation to worry about. So we built a position in that and growth. And it hasn't done much since we did it, but, we're buying it for the next 3 to 5 years. And then, our favorite, which is in, I think, equity income and 12th best. I don't think we own it in growth. I should know that. But anyway, it is, Home Depot is just going to continue to benefit because.
What about Carrier?
Carrier is a problem. Yeah, we're actually having an internal discussion about it. They performed extraordinarily well for a very long period of time. They are dependent. I mean, they have a data center business, but it's very small. And so they are dependent upon housing improving. So, we're not going to sell out of it, but we may reduce our exposure just because I think there's better places to be. So we're pivoting to housing. We'll be early on that. We should be. And, eventually we're going to see rates come in. So, so that's about it. It was great earnings. I think guidance was good. So I expect next quarter to be pretty good. And we'll see if the tariffs, torpedo any of these companies, but so far so good. So.
Yeah.
And then the last thing I'll say is after the guy with the shrimp, Scott Bessent was on Bloomberg this morning, and the most important thing he said, I thought, was that he is redoing his office, but he's paying for it himself.
He's not going to build a ballroom like the president, huh?
Or a Taj Mahal like the Fed chairman. So, it looks like they may sue him, by the way.
I thought the interesting thing was the discussion you and I had about Bessent this morning and just the perception of him. I mean, I think you and I would agree that he definitely is the adult in the room. He's very calm, very staid, very professional. He does, carry the water for the administration. So he talks about rate cuts. I would be surprised if he thinks there's really a chance of a 150 basis point cut coming anytime soon. I don't think it matters who's on the Fed. But at the same time, he's this calm, collected, professional. I was really actually very worried when they originally announced his appointment, because I'm like, oh, great, like a hedge fund guy in there. Like, this is going to be just a disaster.
Work for George Soros.
Yeah. I mean, yeah, like the devil.
Yeah.
But he's been incredibly, I think, effective at just managing the hype and the politics, keeping the messaging, and then also acting, like a professional, like an adult. And that can't be said for everybody.
No, I'll take him all day long over Howard Lutnick and Peter Navarro. I feel like Howard Lutnick would sell the White House if he could. He's just not. Well, that's all I'll say. But
I was going to say, one of the things I really don't like hearing is a president talking down, or up for that matter, a currency.
Right.
We talk about stable coins and crypto and stuff, and cryptocurrencies. I hate the word currency attached to crypto, because the point of a currency is a medium of exchange. So we're not bartering chickens for truck tires and and ham sandwiches. Like, that's a really inefficient economic model, doing the barter system. So money is really money for the transaction purpose. You want stability of money. You don't want a weak US dollar so that exporters benefit, because it kills domestic savers. It's bad for US savers. And that kind of narrative is really not helpful, because it will actually help drive the dollar down, which I don't understand why the president would really want a weak dollar. You don't want an overly strong dollar. You don't want an overly weak dollar. You just want stability of your currency.
Yeah.
Because the consumers are the ones that pay.
Maybe, since it's your dad's 85th birthday tomorrow, maybe you could share the story about him in the White House in the first Trump administration talking about the dollar, or maybe you don't want to. But.
No, I can. I think it's a good story, and it really begs to. I don't think it's really it's not. I didn't take it as a critical issue, or being critical of anybody in particular. It was much more like, hey, look at history, economic history. Like anything, you have to have a good view of how things work, what the rule of thumb is, 80-20 rule, but also how things, what the outcomes are based upon what actually happened. So I believe the story was, my dad was in the White House with the President Trump in his first term, and he was with Larry Kudlow and Steve Mnuchin. And the president was talking about how great a weak dollar was, and how the dollar was very weak under Reagan. And I think Larry and I believe Mnuchin were kind of fairly quiet on the issue. And my dad's like, Mr. President, that's actually not what happened. The dollar actually got very strong under the president, because he was cutting taxes, and foreigners wanted to own a higher rate of return on U.S. located assets. And the only way they could do that was by buying U.S. located assets. And we don't want yen or rubles or rupees or yuan or euros. We only take dollars. And so foreigners had to get dollars to buy U.S. located assets, and that caused a demand for dollars to go up, and the value of the dollar in the foreign exchange to go up. And so we had a very strong dollar, and that kept inflation at bay, and it brought tons amounts of money into the U.S. as foreigners tried to buy assets here. And Japan couldn't export factories to the U.S. fast enough.
Yeah,
and
well,
I think the president Mnuchin and Kudlow said, "Why didn't you guys tell me this?" And of course, they already had told him, I believe. He just didn't remember the story the way he wanted to remember it. But
well,
again, he can't be critical of anybody.
He learned the lesson clearly. So
yeah.
All right. Well, we've gone long. It's good seeing you.
You too.
Thank you.
Thanks everybody for joining us again. We'll see you next week.
See you next week. Special guest.
Bye.